I'm Alisa Gumbs, the Executive Managing Editor of Black Enterprise, and welcome to Passing the Wealth, the Power of Insurance, Wills, and Trusts. Building and maintaining multi-generational wealth is core to the mission of what we do here at BE. And today we're going to talk about two very powerful tools for doing that are often misunderstood and underutilized in our community, and that's insurance and estate planning. We have two experts with us here today who are going to take the mystery and intimidation out of these financial and legal tools so that you can use them to build wealth, preserve your hard-earned assets, and pass them on to the people you love. First, we have Lorianne Douglas, Esquire, a founding partner of Douglas Rademacher, L.L.P, whose legal practice is concentrated in trusts and estates. Thank you for being here.
Thank you for having me.
And we also have Eugene Mitchell, the president and CEO of E. Mitchell Enterprises, L.L.C, and the former manager of the African American Market Unit for New York Life Insurance. Welcome, Eugene.
Thanks, Alisa. I'm happy to be here.
Thank you both for being here. But before we get into the conversation, you both are veterans in your respective fields. You've been dedicated for decades to making sure that our communities aren't left out when it comes to insurance and estate planning. So I'd like to ask how you both became passionate about what you do. Lori?
Well, thank you again for having me. And that whole comment, yes, it has been decades. I hate to admit it, but it is true. It's interesting. I became interested in estate planning really through insurance, because my ex-husband of many years ago was an insurance salesman, and he worked for AXA Equitable. And when we were dating, I was leaving the DA's office and I was looking for a practice area that I could really help the Black community. And before I launched my practice, this is back in the 90s, I was going to help him in his practice. And so I learned about life insurance, and I took the New York State life and health insurance exam so that I would understand the products. And in doing that, I learned about how important life insurance is in estate planning. And that made me think, hey, maybe I could build a practice area in estate planning. And in the 90s, I went to a continuing legal education class on basic estate planning, how to write a basic will. And there must have been 300 attorneys in the class, and there was not one attorney of color. Mm-hmm. And this was either 93 or 94. And I thought to myself, well, I know a lot of Black people who are going to die. And we are not we're not participating. We don't have the practitioners in the area, and we don't have enough education in our community to know why it's so important. So that's when I started concentrating my practice in trust and estates planning, estate administration and probate, and also litigation. And it's a fascinating practice, and it really does help people. And especially during COVID in the last year, we have really seen the need to have proper planning as well as to do proper estate administrations in our community. And so that's how I got here, and I've loved every minute of the practice. I built my practice working at law firms where I could get experience, but then in 2017 I was able to leave and start my own firm.
And Eugene, what lit the fire under you?
Lisa, it's really two things that along my career path that have really gotten me fired up along the way. The first was when I was a corrections officer, a prison guard down in Miami for 4 years in my early 20s. And as I looked out amongst these, majority Black and brown inmates there, I realized that, what we call often as the problems in our society, the crime, the drugs, the non-nuclear households and the likes, I realized that a lot of those were symptoms of a deeper rooted problem in our community, which had to do with our economics. I would wonder, if these individuals had been set up differently in life, had they been given a college savings plan or a startup capital for their own business or a down payment for a home, would their path have been very different? And I believe so. And so that's really what started me on the path of trying to figure out what I could do to help. But as a prison guard, I knew I couldn't do much there. So I went back to finish my bachelor's in finance and went on to do my MBA in NYU, Stern School of Business, and then got hired into a life insurance company back in the recession of 2001. Didn't expect to be there. I was actually interning at a tech company in California back in 2000. But of course, when the tech bubble burst, I knew I didn't want to go back there. And so it was, I think, a divine intervention that I ended up in this life insurance company in this leadership development program where I got to sort of do a profitability analysis of the cultural marketing group that they had at the time, which was targeted outreach for recruiting, with sales, with promotions, with branding to the Chinese, Vietnamese, Korean, Hispanic, and Indian markets. But I asked, what are you doing targeted and specific for Black people? To which they said, well, we just use the general market material. I said, could this really be the case in 2001? We just use the general market material? And to which some other people pulled me aside. Well, they said there's probably more to the story. And I said, well, tell me. And they said, well, there's a belief around here, and some folks have gone to great lengths to say that Black people don't want to buy life insurance. And what you buy are those small burial type policies. And what happens to those policies is that they lapse. And what happens to the agents who sell them? They don't make it in the business. So a lot of folks here believe it's a negative return on investment to put resources into the African-American market or the Black community. And so either way, whether it was just they were thinking we're going to use the general market materials or we really don't see you as a viable marketplace, either way, they got me fired up. And that really put me on the path to figure out what have we been missing? What is it that we don't understand? Or more importantly, how are other communities using these tools in ways that either we don't know or we've not been shown or we just really need to step up and do better with. So that's really what got me going.
As we lay the groundwork for this conversation, before we get into the nuts and bolts of insurance and estate planning, I want to talk about why it matters. And, as individuals, we pay a high price when these things aren't in place. But as a community, the stakes are even higher for us. So can you both share why this is so important?
Sure. Lori?
Well, it's so important in the way you said it is perfect on a personal level and then as a community. So personally, without an estate plan, without proper estate administration, when somebody passes, the family itself will just end up in disarray and lose a lot of money. There's got to be a plan. And if there is no plan, the state's plan, usually leads to unhappiness and unrest amongst the actual family members. And then there are additional costs and delays. And now again, since COVID and the courts have been so backed up, it's just, it's personally devastating to the individuals that are involved who are already grieving the loss of a loved one. In terms of the Black community, it's devastating because our generational wealth is not accumulating, it's not transferring, it's dying with us. Other communities, and I have worked at some, large law firms. In other communities, it's part of the community, the tradition, the lifestyle to do this kind of planning. And when people die, there are plans in place and generational wealth continues with the use of trust and with learning how to use your IRA or your retirement benefits to stretch them, those things. Our community, when somebody dies, you lose money every time. And so if we as a community really started to implement the strategies that these other communities know about in terms of planning and in terms of wealth transfer, we would really start to acquire wealth generationally, and that would make the Black community a very wealthy community in the United States. But we really have to plan, because otherwise you lose wealth rather than acquiring it and transferring it and creating more wealth in the next generation. Unfortunately, our community just hasn't reached a point where that happens with any regularity. In my estate administration on the probate side, What we're really trying to do is maintain whatever we can and try to transfer as much as we can. But the reality is it's not like generational transfers and use of trust. Our community is really just getting to that. But for those that do it, it's making a big difference in their lives and their children's lives and their children's lives.
I'll pick up from there. You think about 400 years here, Black people have been in America, and for the most part, each generation has started from scratch. And like Lori said, we've lost ground. Living in Bed-Stuy, Brooklyn, the amount of brownstones, we talk about the gentrifying neighborhoods, these $1 million, $2 million brownstones that are being, swept up from underneath folks who don't understand, that you needed a will to pass on the property, right? That you needed to cover the taxes. I mean, we see $1 million brownstones being lost because of, basic taxes that have not been paid. For so long, land down south, there's ways that, we've made progress. Businesses aren't passed on properly. We fight over whatever inheritance has been left. And we've got to put something in place that stops that and stems that. And for me, life insurance, I want us to look at life insurance as a source for economic empowerment for the Black community in a way we can build wealth when there was none before, right? That we can protect what we have, that we can leverage the money and the assets that we have and then pass it on for generations to come. See, I think we have to see it as a financial tool like many others do, an investment, something that is not about a bill, but is about building. Is to think of build and not bill when you think about life insurance. And also, I better add in the career. This is a lifelong career that we don't participate in on the scale that other communities do. And so that's a big part for me, is being in that position for 17 years, watching how other races, religions, and ethnic groups set themselves up and their children and their communities with these tools in ways that we're not doing the same. It increases the racial wealth gap. When you look at the current contributors of the wealth gap, and inheritance and family financial support is a component part of that, but we're not on par. We're not keeping up with those around us. And so really that's something that we have to take on more significantly than we.
Absolutely.
You mentioned earlier burial policies, and like a lot of people in our communities, I grew up thinking that life insurance was that thing that you buy so that when you die, your family had the money to bury you.
Yes.
And if they got a couple of extra dollars at the time, great, but pretty much that was it. How should we be thinking about life insurance, and how should we be using it?
Absolutely. And that breaks my heart that we're still talking about burial policies. I think I attribute it to sometimes those commercials that we see often, especially late night, when that old couple comes home and she asks him, if anything happened to you, would I be okay? I'm screaming every time because he says, well, I have a $10,000 policy for you. Yeah, that's not making a difference. That's not setting the family up. Right? When you think about, as I travel around, people are still referring back to the policy Big Mama had, 50 years ago when the white insurance man came to the house to take $1 or $2 a week, on a policy that when she passed, they still had to pass the plate because it wasn't enough to bury her. Insurance has evolved. It's so much more than that, and like I said, and even expanding the thought of, I have insurance on my job. When I was at that prison guard, I had 1 times my salary offered as the way of life insurance in case anything happened to me. That was $36,500 back then. If I was to leave $36,000, I'd not set my family up significantly with that. What I want us to know is that other communities use it and see it very differently. And 3 things come to mind, and the first one is that they're using it for income protection. The second is for the living benefits that you, the insured, don't have to die to benefit from. And the third is for legacy creation. So if I could just take a quick second, when you think about income protection, that ties into the economic value of especially the head or the heads of a household, right? If I'm a father of young children and I want to make sure that if anything happens to me, they'll be taken care of, I have to calculate that if I'm making $50,000 a year and I expect to work another 20 years, that's $1 million I'm going to bring into my family. $50,000 a year for 20 years is $1 million. That makes me $1 million asset. And for so many of us in the Black community, especially Black men, we've not been told that we're $1 million assets. We have to protect that value. If I don't make it home, if COVID takes me out tomorrow, if I get into an altercation, either with somebody else or with a police officer, and I don't make it home, that's $1 million my family won't receive. Right? What will happen to them? Will they have to sell the house? Will the kids not get to the schools that I want them to go to? A big part of the first use of insurance is income protection. The second part are those living benefits. And we often talk about sort of the cash value that builds up, or the savings within some of the permanent policies. We talk about guarantees and tax advantages. I want to let you know that there's even better provisions today from some of the companies out there that will give you money if you have a critical illness, a chronic illness, or a terminal illness, right? So if I have a $500,000 policy or $1 million policy, I can take money from that face amount to take care of myself if I have to go into a nursing care facility, if maybe I have to have treatment for cancer. Especially in our community, when we just heard it this past year, we have more so than everybody else underlying conditions. This is a way that we could take care of ourselves, that use this as a way to supplement and not drain our own resources. And then the third part I want us to think about, well above burial policies, is the way to leave a legacy. Right? It's Proverbs 13:22 says a good man, or the current version says a good person leaves an inheritance to his children's children, right? The way of leaving $250,000, a $500,000 to your grandchildren and great grandchildren. You can, like other communities, pay for their college education, the down payments for their homes in the gentrifying neighborhoods. That's how other folks get 20% down on $1 million brownstone. Most of us are not going to earn 20% down to put down on a brownstone. But if you receive it when grandma passes away, that's what puts them ahead of themselves, right? The startup capital for new business, or even leaving a legacy for the college, the HBCU, your sorority, your fraternity, an endowment, charitable giving. This is a way to ensure and guarantee that you can pass something on. This is what I say, we have to go deeper into what the understanding. You said it at the beginning, it's misunderstood and underleveraged and underutilized. These are some of the things I get really passionate about, if you can tell, that we have to take on and that we've been missing in our community.
So let's talk just a little bit about some of the nuts and bolts of it, because I know even when I was first looking at insurance, I got stumped right off the bat with two things, which is, how much do I need and what kind of insurance do I need? So when people are first starting out, what should they be considering in order to do these calculations or to make these decisions about what kind of products they need?
Thanks. I believe starting out that a young couple especially needs like a term policy. It's usually a specific term, 5 years, 10 years, 20 years, even 30 years. Because it's only for a limited amount of time, and it limits the exposure that the company has to pay out in the future, it costs less. And so for some of us who have never had insurance, or don't know, to add it into the budget for each month, starting with a $500,000 policy for perhaps $50 a month is something that we can start to get comfortable around. And then and then some of those, and I'd advise you that as you take out the term policy, see if it's convertible to a permanent policy. So as you start earning more, as you start sort of getting rid of some of the bills that you have in life, you can convert over to a permanent policy that lasts your entire life. That's where you get the whole life, or the universal life, or index universal life. There's a lot of permanent policies out there that add additional benefits, but those become more expensive. Those are more of your investment type tool. So starting with, and as you go further in life, I believe a combination of the two is something we should take on. So a permanent policy and a term policy. I know some companies and some pundits will say, buy term and invest the difference. I don't believe us in the Black community invest the difference. We're shy of the stock market. We don't put them. So I think it's a disservice for us to keep hearing that over and over. And or just buy whole life. That's all you need. Because a whole life policy, because it's more expensive, you typically get a smaller face amount. So that might be the $50,000 or $100,000 policy. I want if some of us, if we pass away, because we're all going to pass away one day, but it's say we don't get out of life alive. When we pass away, let's make sure that we pass on something of significance to those that we love. And the easiest way, I believe, is a life insurance policy. I mean, the other ways you pass on wealth is through real estate, through business ownership, and proper management of the assets that you already have. But the easiest, the most guaranteed way to do it is through a life insurance policy.
Lori, I want to bring you into the conversation now because, life insurance is one of the things that could fall under the umbrella of estate planning, but there are a lot of other things to consider. And most people have no idea what a comprehensive estate plan looks like. So can you walk us through that?
I will, but first I want to add 2 pitches for life insurance because it was because of life insurance and learning what it did, how important it was in estate planning that got me into estate planning. And I find sometimes that for a lot of us, they'd rather hear from somebody who doesn't sell life insurance as to why is life insurance important. And I'm going to tell you, I don't sell life insurance. I don't make any money from promoting life insurance, but it's so important for 2 reasons. One that was already mentioned. One is income replacement, but it's not only income replacement for, if the breadwinner or even the spouse that's not the breadwinner dies, to replace that income for 10 years or 15 years, but also if you have children, those education expenses. And so if you make, in the example, if you make $50,000 a year, so you need $1 million just to replace the income if the $50,000 breadwinner dies before that child is, 16 or 17. But then what happened to the college? There was no, there's no money there for that. So that might be, you now need a term policy that you increase by another $500,000 just to cover those 4 years of education costs. So you really need income replacement if you lose, the parents when you have young children. And if nothing else, COVID has shown us that very unexpectedly, young people just die. And so if you have young parents that sort of just die, but you've had a term policy for, $1 million, $2 million, it might not cost that much and you may never use it during the term. But if you need it, really has been a valuable investment. So that's one on income replacement. But the other thing that's so important about life insurance, and I think was touched on, is the concept of investing the difference. If you don't invest the difference, then you don't have it. And so that means you don't have liquidity. And when somebody dies, whether you have a lot of money or not so much, there's a good chance you need liquidity in your estate. If you own a home, the brownstone, if you own that brownstone and mom passes, well, the real estate taxes still need to be paid. The homeowner's insurance still needs to be paid. There may be a mortgage. The utilities have to be paid. If you die in the wintertime, you can't turn off the electricity, the pipes burst. And so you have to have cash. And one way to have cash readily available is through life insurance. And so liquidity is a really important reason to have life insurance. You might, unfortunately, people pass before they've either made that money or they have not been so conscious in investing and saving. So you do have that liquidity at the end of the day, which is important to know. Yes, we're all going to die one day, so it's going to be used. So now, in terms of an estate plan, and when we talk about estate planning, we really mean for what you need based on your circumstance. So just having life insurance may be the only estate plan you need, but you've done estate planning by buying the life insurance and making sure. So if you're a young couple and you've just had a child, you might only need $1 million life insurance policy is really all you need with the beneficiary as the surviving parent. That might be the plan because you don't own anything yet. You haven't funded your 401k yet. There might not be anything, but that's a plan. But for most people, we need at least a basic plan for what happens when you pass and for what happens if you become disabled. So when we talk about an estate plan for when you pass, that's either using a will or a revocable trust and a combination of these documents that will allow you to easily transfer your wealth. But while a person's alive, and so important and can be done by anybody, everybody listening today could go do it today and get your medical and financial directives. And during this pandemic, young people suddenly were stricken and could not make medical decisions for themselves. They didn't die, but they couldn't make medical decisions. And if you are over 18 and you are single without that healthcare proxy, your mother can't make that decision for you. And so it's really important to have a healthcare proxy. If you become disabled and you can't make your medical decisions, to have a loved one appointed. It's important if you're at an end of life circumstance, people who have had COVID and have passed unexpectedly, those people who had planning, a living will, which would say what would happen if you were terminal or permanently unconscious, irreversible brain damage. You'd want to be removed from life support if that would prolong your natural death. And then we need to have a financial power of attorney. If you can't make your financial decisions, you can't pay your bills, you can't pay your mortgage, somebody has to be appointed to do that. And the financial power of attorney is so important. It varies from state to state. And so it's really important that you do it for your state, but that you understand it. So for example, in New York, the financial power of attorney, the law has just changed. As of June 1st, we're going to have a new power of attorney because they made the power of attorney so complicated that for the last 10 years or so, people have been doing it wrong. So now they're changing it to try to simplify it so that people understand. And one of the things that's really important in planning is to be able to help someone if they become disabled to move their money, to make transfers, to fund trusts, to gift to children, to plan for Medicaid. And if you don't have somebody who has the authority to move more than $500 of your money, you can't plan. You can't do Medicaid planning. If you're disabled and now you need to go into a nursing home and you haven't had somebody who's there who can do these things for you, you have to go to the court. And that's the only way to get appointed. Somebody gets legally appointed, your guardian or conservator. So without having these documents, if you become disabled, you're really left at the mercy of the court system. And if you don't have a proper plan when you pass, I mean, you know, your family members lose money. They fight. It doesn't get distributed the way you want to. I mean, we look at somebody, sadly, right? DMX just passed recently, and we haven't heard anything about any will. I don't think there's a plan, and he has quite a few children. So it's going to be a complicated estate administration without a plan. But, you know, most 50-year-olds don't have a plan. Most of my clients, you know, they come to me when they're over 70 and they say, oh, it's about time. I'm thinking, you think? It was probably about time when you were, you know, 30 and had your first child. But it all worked out. So that's the thing. You have to do it, because if you don't have it when you need it, it's now too late. But right now, today, everybody can start doing their planning. And with medical and financial directives, healthcare proxy, living will, powers of attorney, those are often statutory and they can be found online from your state. You go to your Department of State website or your public health website, and title companies often have financial powers of attorney. So you can get these documents free and execute them yourself. Just be sure you execute the form for your state, and then you'll be fine. Anything else more complicated, you should go see an attorney who knows how to do the proper planning and create the wills and the trusts and the documents that you need.
That is so important. And I'm going to underscore what Lori just said, that you can go today online to your state and get the information you need for financial and medical directives and do it yourself.
Yes. Now, I'm going to put a little caveat. I would not recommend doing your will yourself or doing a trust. I spend a lot of time. I get a lot of good business nowadays from people who have done their documents on LegalZoom or another software program themselves, and they are a mess. And sadly, a lot of people have come to me, asked me to review so we can fix it. But those people who have done their own and then they pass and then they get state administration is much more difficult. So yes, financial and medical directives, you can do them yourself, but don't try to do your will yourself.
Well, speaking of wills and trusts, let's just go back and break those down for people, because I think, most people sort of understand if they own something, they need a will, but that's probably like the end of their understanding of it. And most of us, I don't think, understand trusts at all. When we hear trusts, we think, these are for wealthy people who've got like a lot of assets, they want them hidden or something, we don't really understand them.
Right. Well, so there are a lot of different types of trusts that can get a little complex, but in a general sense, what a trust is just a way of a legal entity to own assets. And so a revocable trust, which is the type of trust you hear people using in planning that with a will, a revocable trust is a vehicle where you can fund your assets into it during your lifetime. So if I prepared a revocable trust for myself, I would then take the deed to my house and change it from my individual name into the name of my trust. I would take my bank accounts, I'd retitle them into the name of my trust. I would take my retirement plans and change the beneficiaries to the trust. And then that trust says how I manage the assets while I'm alive, while I'm competent to do so. But then that document has in it built-in language and built-in fiduciaries for if I become disabled or I die. So now my trust says if I become disabled, bring in these disability trustees. And that's, my brother and my adult son and, my father, the adult trustees. And then if I pass, then those death trustees, now they come in and they administer the trust. And that trust will now say on my death, put it in a further trust for my son. And so this allows you to transfer your assets without having to go through the court system, because if you don't have it in trust, the other way is through your will, right? And so then you have to probate a will. And many people don't understand your will is just a piece of paper until a court says it's authentic. So when a person dies, this happens all the time. I have clients all the time. They call me and say, oh, my sister died 5 years ago. I'm the executor of her estate. And now I'm in a dispute with, my nieces and nephews about X, Y, and Z. So I say, well, when did you offer the will to probate? When did you get appointed? And they say, what are you talking about? I'm the executor. Here it is right here. That's just a piece of paper. You have to take that document to the county, to the surrogate court or the probate court where the decedent lived, and the court has to authenticate it. They have to look at the will, they have to get all your family information, you have to file the paperwork, and they say, yes, now you can go forward and administer this estate. So you can put trust in that will if you want to, but you have to go through the court. By having a revocable trust that's funded during lifetime, you can skip the step of going through the court, but it still has to be administered. And so that's a kind of trust that's a will substitute. The other kind of trust you hear about, irrevocable trust. Some are done for Medicaid planning to transfer assets so that you can receive nursing home care. You hear about irrevocable trust, an irrevocable life insurance trust. That's in order to freeze your estate or to get assets out of your estate so you don't pay additional estate taxes. There are all kinds of charitable trusts. You want to provide for your family, but you also want to provide for a charity. You can set up a trust where you can get income tax deductions as well as, build wealth for your family members, but provide for charities also. So there are lots of different trusts to be used, but in a basic estate plan, all of our basic estate plans are either a revocable trust that the client funds during life, and then on death, the trust says what happens to the assets, with a pour over will that we do just in case you forget to put something in the trust. So we really do that because we're trying to keep people out of the court system. The courts were bad enough before COVID, but having closed for many, many months, they're really quite backed up. So we're doing a lot more revocable trust-based planning. But I also, and from a background and from, the years of working at the big firms, we also promote all trust-based planning, whether it's in a revocable trust or in a will. And what that means is we never distribute outright to children or grandchildren ever, because if you say I leave, my house outright to my son, now he sells it, and now he could be susceptible to creditors. He could get divorced. There'd be reasons why creditors can get to that inheritance. But if you leave it in trust and it stays in trust, they always have creditor protection. There's always spendthrift protection in case they, want to go out and blow their inheritance. So by leaving it in trust, it protects the beneficiary from outside creditors, from a divorce, from the IRS, from you get in a terrible accident, you don't have enough insurance. It also protects the beneficiary from themselves. They run around and spend their money foolishly. And it allows for generational transfer, because by keeping the money in trust, keeping retirement plans in trust, and following the proper rules, you are then building wealth in each generation, and you're only paying your taxes slowly or less. And that's the part of the planning that helps to create wealth, is that part of saying what kind of trust we use. But we say always keep it in trust. It doesn't, I don't care, at 40, your kid can figure out how to get it out if they need to. But by having the protection in there, that is the first key. And most people, they don't understand that at all. They don't understand that there's the option not to just end up giving their child, $1 million or something right outright. But that's the real benefit of trust, using trust-based planning. It helps to control the money or the assets. It helps the beneficiary to have advice on how to manage it. It protects them from creditors. It protects them from themselves. And it allows for a vehicle to create generational wealth.
I think two of the most important things we heard today speak to some of the misconceptions that there are, that insurance and estate planning are not just for when you're old, and they're not just about when you're dead, because there are, living benefits that you've both mentioned. I think there's a lot of resistance in our communities to talking about this kind of planning, because you have to accept talking about the possibility of sickness or incapacitation or death. And so for the two of you, what have been some of the biggest obstacles you've seen to getting people on board with this kind of planning, or the biggest misconceptions, and how do you counter that?
Alisa, I want to weigh in because you pointed out two things as takeaways. I also want to talk about, so far we've talked about using life insurance individually. I think the greatest accomplishment that I had working those 17 years at New York Life Insurance was putting together a campaign that put $50 billion of life insurance on the books by the Black agents for the Black community. And the formula here was to get 200,000 African Americans out of 46 million to see the value of owning at least a $250,000 life insurance policy. So this wasn't the 10,000, it wasn't the 20,000. We talked about starting with $250,000 to start to bridge the racial wealth gap. And if you multiply it out, 200,000 people with $250,000 of life insurance will create $50 billion of protection and tax-free future income. And so when you think about we're all going to pass at some point over the next 10, 20, 30, 40 years, whether you insured your parents, insured yourself, insured your children, that would have been $50 billion that is going to benefit the families, the friends, and the businesses of those 200,000 people. And what can't 200,000 people do with $50 billion? Right? When you think about just not only with individual families, but cycling $50 billion into Black-owned businesses, right? Putting deposits of $50 billion into Black-owned banks, right? They talk about the start of the endowments that we can create, the tithing into Black churches. It breaks my heart to think about the 550,000 plus Americans who've passed away last year because of COVID. And according to the website covidtracking.com, they predict that 73,000 African Americans have passed away over this last year. Had they participated in this campaign with at least a $250,000 life insurance policy, that would have been $18 billion. 73,000 people passing away with $250,000 of life insurance each would have been $18 billion that would have been paid out from these life insurance companies. Think about how that would have set families up, created real community transformation. This is the potential of this tool. This is what really gets me. You started off with a passion. What gets me passionate to think about the true impact and change that we can create with this, right? To think about that it is in our hands. We talk about the lack of access to capital in so many ways, in businesses and homes and mortgages and the likes. But this is a tool that we have access to. Right? It's most cost effective when you buy it when you're younger and healthy and you have the income to pay for it. But I believe we have to think about how to use it collectively. And not only, like I said, across the community, but even within families. Another quick story I got inspired by that me and my sister went to my parents with. I'd asked, what other stories, what other ways is it being used that maybe I didn't know? To which I was told that, well, you live in Bed-Stuy, the Jewish family next to you, they'll take out $1 million of life insurance on the two oldest in the family. Then that family of 20, the 18 others will make the payments on it. What? Yes, they talked about coming together to pool their money into an investment to generate $2 million. And in their mind, it wasn't about profiting off the death of grandma and grandpa, but about holding them up as the matriarch and the patriarch. Because from that $2 million, they will pay for their grandchildren and their great-grandchildren's college education. Right, they would give them that 20% down on multiple brownstones in Brooklyn that have rental income to come in. Right, they give them the startup capital for their businesses. So imagine you have no student loan, you get to start your own business in your name with the funding from the family, and you have a house to live in with rental income. These are ways that I think we can use and leverage these tools collectively, not just individually. And I think this is what I want to shed more of a spotlight on that other folks are using and doing around us. Same thing in my book, I talk about ways that we can insure our children and build it like wings of financial freedom for them. So that's what is passionate for me. And to answer your question, Alisa, in a roundabout way, I think sharing the ways that we can and should be using it has overcome those obstacles from the past, right? And instead of just trying to go back and forth to say, to combat the individual points, I'm going to show success stories. Right, when the middle-aged nurse passes away and said, I only wanted $100,000 of insurance, and the insurance agent says, for a couple dollars more, adding a term policy, I can get you $1 million. If anything happens, don't you want your daughter to have $1 million? She says, okay. And when she passed away 2 years later, he gets to deliver to grandma $1 million check to pay off the mortgage. To as Lori said, pay the college education for not only the undergrad, but also medical school, because this was a nurse and her wishes were for her daughter to become a doctor. So we've created millionaire Black families. That this isn't just sort of a lottery ticket that happening by chance. This is because somebody sat down and put a proper plan in place with an agent and sat with an attorney like Lori to get a will and a trust to make sure it goes where it's supposed to go. So this is within our grasp, it's in our hands, and it's happening. We just need to ramp it up. That was a $50 billion campaign I led. I'm putting together now a $500 billion campaign across the industry. I want to see all the companies come together to do this and to really think about how we can really set things up in our generation to make a difference for the generations to come.
And one thing, Alisa, I just want to say, in terms of when you were saying it's not something to wait and the myth, one of the myths is that it is something that you do when you're older. But the reality is you really need to start your estate planning, especially with life insurance, when you're younger because of health concerns. And we've seen in our community that the reason that COVID was, worse in our community or killing more people in our community, a lot of it had to do with the underlying health issues. And so if you wait until you're 50 to try to buy life insurance for the first time, by now you may be diabetic or have high blood pressure, whatever. But if you buy it when you're 30 and you're still healthy, you get better ratings, you get better, the premiums are better. So it makes good sense start the process when you're young, no matter what. And then as you get older, you do more planning for your circumstance. But starting it when you're, in your 20s and 30s really makes a difference in terms of not only what you invest or what you make during your lifetime, but being prepared for your family to be prepared if there's, later on you're uninsurable, for example. I've had, I know of clients that, they bought insurance on their teenage kids just because they bought it. And then by the time they were in their 20s or 30s, had really significant health issues and were now uninsurable, but they had gotten the insurance. And so, sometimes you're not going to die from the significant. You could have Crohn's disease, or you could have something where you live a long life, but you become uninsurable. So now those teenagers who are married with their own children, there's life insurance on them because their parents thought to buy it when they were young.
Love everything you said.
Lori.
To add on, it just, because my thought, it also is about mindset. We're shifting mindsets. And so if I have $1 million policy, if I know I'm $1 million asset, then might I take better care of myself, right? If I had $1 million car, I would take care of that, put it in the garage. I'd make sure that it had the alarm. If I had $1 million home, I'd have the same thing, the insurance, the alarm. I might live in one of those communities that my cousins can't come over unless they call first, right? If I had $1 million racehorse, right? I would make sure that, I wouldn't have it staying up late at night, smoking and drinking, right? Eating fried food. Not going to the vet on regular visits, that we take care of other things, that we feel have value. To your point, we have underlying conditions. It's sort of hereditary, but we could take better care of ourselves. And so once we start thinking in that space, hopefully if we can know it, we're going to pass on something of significance, we should be teaching our children how to manage their money better. Right? That we won't be distracted by the social media and the athletes and the entertainers and the sort of the reality TV of spend, consume. We're talking about generational wealth. And this is my expectation. This is what I'm passing on. This is what I didn't receive. And I'm making sure that I start it now going forward, but I don't want you to blow it. Right. That's why I put the trust in place so that you won't just blow it. But I also want to do, my responsibility is also to help you manage it and handle it properly going forward.
Well, I have to thank you both, Eugene and Lori, for everything that you've shared today and for all of the passion that you've shared it with. I hope it's really been communicated to our audience and that everybody out there has been paying close attention. This information has been invaluable. And I hope that you're all ready to start today to put things in place to make sure that you are building wealth and passing it on to your own families. Thank you so much.
Thank you so much for having us. And if anybody has any questions, you can always email me at lori@drestateCouncil.com.
And thank you for the time here. Same thing. Please don't do this by yourself. Meet with an agent or a proper financial advisor. Don't go online, as Lori said, to do your will, just to take a chance with a life insurance policy. Sit with a professional. My website is eugenemitchell.com. My book is Closing the Racial Wealth Gap: 7 Untold Rules for Black Prosperity and Legacy, where I share more of these strategies and ideas and ways that we can build wealth for our community. Thank you.
Thank you.